Hey guys, in today's video we're going to talk about some of the best investor-focused mortgage products in the market today. We're going to talk about some B alternative lending, mortgage investment corporations, and small commercial financing products.
We're also going to take a look at CMHC's MLI Select and their standard rental product, along with our commercial repositioning product, so stay tuned.
Hey guys, Josh Ehren from the Findlay Mortgage Team. In today's video, we want to talk about some of the best mortgage products for real estate investors in 2023. As many of you know, this means in turbulent times, and investors are always looking for some unique financing solutions for their investment strategies. This market has caused investment strategies to change, and in that, the mortgage solutions that we're offering in the market are changing as well.
Yeah, I think one of the biggest topics moving forward is going to be, with the higher interest rates, is going to be affordability, and a lot of these products, push that affordability side on both the residential and some of the commercial assets that we're working with. So I think the first thing we want to look at is, our B lenders, our alternative bank lenders. So, still some misconception, I think, around the B lenders where a lot of people either don't know they exist or they think it's kind of lumped in with our private lenders and our MIC lenders, and it's completely opposite. So the B lenders are federally regulated institutions. They're a Schedule II bank. So they fall into the bank category, not on the private category. They offer a lot of great products such as, higher amortization, so 35 and 40-year amortizations, greater rental usage. So you're anywhere from 75 to 100% rental offsetting in some of these lenders. We get non or contract rate qualification or non-stress test qualification. So this is super cool because we can qualify your contract rate and not 2% above. So let's say your contract rate is 6.75, you're qualifying at 6.75, not 8.75 like you would on a standard product. So that's going to help with your affordability right there as well. And one of the other things that the B lenders allow you to have too is just higher debt ratios in general. We're on the A side, typically we're limited around 44% TDS, so your total debt servicing. On the B side, we have lenders that'll actually go up to 60% TDS. So when you're looking at stretching a refinance coming out of a BRRRR, maybe you have some debt left over that you weren't able to pay out with all the proceeds, and you need that little bit of extra room for qualification. We can stretch the amount of debt that you can have on your application compared to those A lenders.
What's really interesting about B lenders is that B lenders are more solutions based. So they're basing their lending off of the story as well as the current market conditions. We find that when things start changing in the market, such as rates or values, that B lenders are the first to create products around helping and find a solution. Whereas A lenders are very like, this is my box, this is where I fit, I'm at the top of the totem pole. So if you guys are in a situation where your values have decreased, or you're looking to stretch out your amortization or your debt servicing ratios to qualify for a loan, there's a stigma around B lending, and I don't think that it's warranted. I think that the solutions that they offer in the market are needed, and as we continue through 2023, at the end of 2022 and into 2023, these solutions are more required from investors. I think that these B lenders are going to fill that void or fill that gap to the solutions that are required.
Yeah, and especially for those who are looking to scale their portfolio, you're gonna hit a limit on the A side. Usually it's around 5 to 7 properties, depending on what the mixture is of rentals and primary residences. But on the B side, we have lenders that don't have a limit. You can buy as many properties as you want, as long as your debt ratios and the application make sense. They don't have a limit, so you can continue to scale. Business for self-investors as well too. We know that you don't show as much income on your T1s. We can use your bank statements to qualify off of your business income, that gross business income. So that's going to give you a lot more income on the application, and is going to allow you to scale.
For sure, and that the whole business for self, product that they offer, it's completely underrated. A lot of investors who are very cash heavy, they're self-employed. They're people who have found a way to be able to maybe reflect less income on their T1 general for tax purposes, but are very cash heavy. And being able to use these types of products in a market like this, where asset prices have dropped, you want to be able to take advantage of being able to purchase properties on a discount. So to be able to do that without having to have a a higher personal tax obligation, you can utilize these products to help you scale. This is kind of like a middle product, whereas on the A side maybe it doesn't fit or you have too many properties. The B side, it's like the step 2. You can either continue to purchase with your GDS TDS ratios, try to squeeze a few out, push out the amortization, and then we move on to commercial financing, which is kind of more of a long-term strategy. But something that is also underrated is you can use both B lending and commercial lending as a strategy for acquisition and then refinancing and stabilization later down the road.
Yeah, definitely. So I think continuing with that alternate type financing solution is the next thing is that small commercial financing that we've talked a lot about over the last year and a bit. The small commercial financing, for those who haven't seen, is basically we can take commercial financing and apply it to 1 to 4 unit residential properties. Now right now, we're coming to the end of 2022. Not as effective on a 1 and 2 unit building, maybe a duplex depending on where you're buying it and the purchase price, but I think we're really focusing on 3 to 4 unit properties right now. What the small commercial product allows us to do is get away from the focus of you as an investor on your personal debt servicing and your personal income and focus a lot more on the asset itself and the amount of income coming in and its ability to service its own debt and its mortgage payment. This is going to help a lot of investors, that are scaling. We don't have the same property size limitations on the small commercial side that we do with residential, and like I said, get away from that those TDS ratios that are going to really limit a lot of people, and then the main reason why a lot of people move over to commercial is just those debt ratios. So being able to focus on the assets is very beneficial, getting away from your personal stuff. It also allows us to create an exit strategy a lot easier as well too, because it's very easy to reverse engineer the numbers. We can figure out where your rent's going to be and hypothetically where the building is going to be based off the cap rate in that area. Your expenses are pretty much going to be the same, maybe a reduction in some utility costs, but it's very easy to figure out exactly how much rent we need to be able to get you that target refinance value, and then that's going to allow you to determine too, like, how much are you going to need to spend on your renovations, what type of renovations are you going to need to do. Do you need top tier market rents? Well, then you might have to spend a little bit more on your renovations to be able to attract that type of renter.
Yeah, and I find that a lot of investors really enjoy the definitive answer at the acquisition phase of their project. So if you are buying a project and you don't know where the market's going to be, but you're trying to figure out and dial in where your ARV number is going to be, we can very definitively tell you how much rent you need to have on a property to be able to service a 75% loan to value refinance on the back end. And then that just says if you have a viable project or not. And a lot of those numbers just need to be dialed in with your mortgage broker or with your realtor to understand what's fair market rent in the area, and is this a viable project based off of how much capital I have to invest in that project.
Yeah, and when we're looking at like how we can use those products together, as we know, on acquisition rents tend to be low, or maybe you're getting a vacant building. In that case, the small commercial financing just wouldn't work. We need leases in place. So that's where we could use a B product, use the market rents, use your own personal income to help get you into the building. You do your renovations, you get the tenants in there, and then we can take out onto commercial financing on the back end and allow you to qualify that way. In holding companies, in personal names, however you're looking to get them financed. Just a really good overall strategy.
What's really cool about that too is, you can, the power of your portfolio is taken into effect when you use a B lender. Because they have such a high rental offset ratio, like 80% to 100%, if you have high like cash flowing properties or properties that have a lot of rent in them, you can almost offset your entire portfolio, and it'll be beneficial for the acquisition of the property. And then, as Ehren said, we can just plan your takeout financing with commercial debt, which would not necessarily reflect on your personal ratios and allow you to be able to transition into a more long-term sustainable mortgage product with conventional debt.
Yeah, and on that takeout financing too, your commercial financing loan is guaranteed to cash flow out of the gate because they don't lend on properties that aren't cash flowing. So when you're doing that refinance, you're walking away with positive cash flow.
Yeah, it's a phenomenal strategy to implement, especially if you don't necessarily have a high T4, T5 income, or you don't have the ability to be able to raise your income on paper.
Yeah, or for those investors that have walked away from their 9-to-5 job and are just living off of their rental income, you're not going to be able to get tier 1 bank financing. You're probably not going to be able to get tier 2 bank financing. You're going to be focusing on that small commercial.
Completely agree. Another pillar of investing products that are kind of changing in this landscape right now are mortgage investment corporations. These are the pillars of private financing. As we've seen in this market, we have such a need for this type of capital. It's very niche, it's very specific to certain investing locations, strategies, and asset classes, but these are the kind of like the forefront of products that are changing at a pace which we haven't really seen before. At the start of 2022, a lot of the larger mortgage investment corporations halted lending because they're very asset-based and asset prices were kind of in a state of flux. They stopped lending, and I think they waited till the market stabilized to be able to figure out where they were going to land and what products are going to be needed in this market. Now that things have kind of stabilized out and we think the majority of the downside of depreciation in value has stopped, a lot of these lenders are back at the table and they're looking to invest heavily in the asset classes that they're offering. So some great products that are out right now are no-doc products. We're still 75% loan to value in major urban areas, no documentation required. So if you have a purchase in this lender's geographical area, which are most major areas other than the GTA, this is a great product to utilize if you have maybe some higher debt on some properties, or you're in the middle of some projects that don't have income being generated at the moment, but you still need to qualify for a loan. You can cap in fees in the loan amount. They're very flexible when it comes to trying to find a solution. It's very solutions based, but it's also based off of the asset value itself.
Yeah, and interest rate wise, it is private money. So we're looking at, the mid to high 8s, maybe in the 9s, depending on where the property is located, what type of, product that you're using for the MIC. They have interest only options, but they also have amortized options as well too. If you want to go with a 40-year AM, you can. So there's lots of creative products, different types of products that you can use with them to help, with your investing. Again, they're not TDS related, like Josh said, so we're not worried about trying to be able to afford, quote unquote, afford like an A bank would be on that purchase. Great for properties that are kind of distressed, that wouldn't fit your typical A and B bank on the appraisal in terms of property shape. So a great solution, again, being able to get into the property, reposition it, and then taking a look at one of our other types of financing to get back out.
Yeah, and one of the great things about federally regulated private mortgage investment corporations is the renewal cost. If you think this is going to be a longer term play, like you're in a project that's going to take 2 years instead of 1, taking a look at this and the renewal costs at 0.25 basis points or 0.25%, that is marginal compared to true hard money. True hard money, you're going to have recurring broker fees, lender fees again. Keep in mind that the type of capital you're going to be using and the duration of your project is extremely important. So these lenders out there are tailoring their products right now to the market, and they're still able to offer solutions at decently competitive prices and decently competitive rates.
Yeah, very popular option too for some construction financing as well too, where they'll base your entire loan off of 80% of your as completed value, where some lenders are actually basing it off of a loan to cost value. So you're actually going to get a little bit more in your total loan structure. And some other things that they have too is infinite draw type structures. So that's something you're not going to see on the bank side. So they have a lot of very niche products. They're very cool lenders, and they're here to help the investors.
Completely agree. Another product that we've seen being pushed into the investor space more frequently is the CMHC products. The higher amortization and the higher loan to value options on takeout financing has become almost like a staple in the takeout financing for most people who are looking to invest in multifamily assets at the moment.
Yeah, right now with the way the rates and the environment is in 2022, on these commercial financing or on these commercial deals, one of your only exit strategies really right now is getting into CMHC. It's very tough to be able to reposition and get out into a conventional type mortgage. The rates, you're sitting in the 6.8s, 6.7s right now, depending on the building. With that 25-year AM, it's just very tough to be able to get that 1.2 debt servicing, 1.15 that we need to be able to get that product refinance. And when you're looking at trying to get all your money back out, refinancing at 70% loan to value just isn't enough for some people to get those proceeds back and be able to put them back into your next project. So like Josh said, when we're taking a look at the CMHC products, you have loan to value up to 85%, up to 95% depending on the product, amortizations from 40 to 50 years, and rates that are significantly lower. Now, right now I think we're in that 4.5 to high 4 area. So it's a really great product. really pushes the cash flow, and it's going to give you a lot more equity on that refinance to be able to use towards your next product.
What's important to note is there are a handful of different lenders out there that offer CMHC financing. So some lenders are, don't want to touch anything above or under 2 million. Some lenders can do deals under 1.5 million. You can have mixed use commercial properties, you can have multifamily commercial properties, essentially anything above 5 units. Now, it can be a little bit challenging when you're in the million to 1.5 million range. A lot of banks see these deals as the same amount of work as something over 2 million than it is under 1.5 million. So you might be a little bit limited if your loan amount is under 1.5 million, but these CMHC products I think they're going to be more prevalent in the space. I think that it's going to be more of a viable exit strategy as we see rates increase and as investors are trying to pull out capital to reinvest. And I kind of like the idea that one of the requirements from CMHC is to reinvest it back into multifamily assets. There are some restrictions around capital takeout and what you can do with it, but I think that in the long run, because it's a crown corporation and it's federally regulated, that because they're having people invest back into the country and back into the infrastructure, I think overall it's going to be a positive thing for the country.
Yeah, and then just touching base on the lenders too, you do have to be careful on who you're using to acquire some of these properties with when looking into CMHC. It is a pretty dark gray area for some of these lenders that aren't directly signed up. So just be careful. If your end goal is to go directly into CMHC, there are specific lenders that you should probably work with just to be able to make sure that transition is a lot smoother. And I think the last product we want to touch base on is our commercial repositioning products. So quite a few different products that we brought to market this last year. One of these products is a 90% loan to value product for loans up to 1.5 million. There's a 3% fee that's charged by the lender that splits between us and the lender, but it's built into the mortgage. So that's one of the things where, if you have to go private, you typically do have these higher fees and you're anywhere from 3 to 4% out of pocket. But this product that we brought to market, it's capped in there. So, you're 90% loan to value potentially plus that fee capped in. So just trying to keep as much costs out of your pocket initially and as much funds going towards the project. Another product that we have is with one of our big bank lenders. For us, we have our preferred status, so we're able to underwrite these deals at 1% debt servicing, which is a very strong asset to be able to have because a lot of these lenders are underwriting at 1.15, 1.2%, so which means that that's the difference between having to go on a private lender, in a 9% rate with fees versus going with a bank lender having a much lower interest-only repositioning term, less fees, and some of these lenders are doing 75% loan to value plus 75% loan to cost on your renovations. So you're getting a little bit of money to actually go towards the repositioning and the renovations. Again, putting a little bit more money back in your pocket. They're one of the largest CMHC submitting lenders out there. So, their expertise on being able to reposition the asset and directly refinance into CMHC, is 0 to none essentially. So a lot of great products out there. We have some of the private mix as well too that essentially piggyback off these A lenders. So again, if we can't quite get the product to fit with our bank, we can go to the MIC. They'll do that same type of structuring, 75, maybe even 80% loan to value with the private mix, and then again 75% loan to cost on the renovations. And again, these MICs are directly signed up with CMHC, so there's that ease of access to be able to reposition right back out.
I think it's safe to say that there are a handful of products and services in the market right now that are here to help real estate investors. As we see the transition from investors moving to different types of investment strategies and different types of asset classes, these lenders are going to start creating products and services that are based around helping people grow, especially in this type of market. If you guys have any questions about any of the products and services that we talked about today, please feel free to reach out to us. We're always happy to help. Set up a free consultation. We can run through your numbers, both on the commercial side and the residential side, as well as outlining any sort of strategies for using different types of capital to help you transition from acquisition to stabilization. If you guys like this content today, please hit the like button, hit the subscribe button. It helps us create more content like this for you. We really appreciate you guys reaching out and watching today. Thanks so much.